Welcome to CB1 Capital's 5 Questions series. My name is Josh Felker. I'm analyst here at CB1 Capital. Today I'm joined by Eric Offenberger, CEO and COO of Vext Science. Vext Science operates in Ohio and Arizona and maintains probably one of the most singularly focused vertical operations we've seen from any cannabis company. Eric, thanks for joining us today.
Thanks for having us, Josh.
So, Eric, because of some of our watchers might not know Vext, or maybe because this is the first time you've been on CB1 5 Questions, could you just give a brief overview of Vext business and where you view your specific competitive advantages?
Yeah, Vext, as you mentioned, is based in Arizona, but our big focus has been on Ohio, and we've been working on growth in Ohio. In Arizona, we have the 2 stores and we're vertical with cultivation and other assets. I think part of the advantage of Vext is the fact that we never expanded beyond what our capabilities were from a capital standpoint and always stayed focused on the capital and on where the growth opportunities really were. And we built the company that way. So we try to own our assets and we finance a lot of times with those assets under a traditional mortgage standpoint. And I think that's been one of the differentials, and you're seeing it in Arizona where we've been able to exit the cultivation area in Arizona as it's been oversupplied and take advantage of that oversupply and recognize that it's cheaper for us to buy than it is for us to grow. And that gives us that flexibility. Where in Ohio, its market structure is at a different thing and it behaves differently than, say, Arizona. But that's always been what we've always approached is what does the market want to do? And we participate in the market. We're not really going to set the market. And if we keep the structure and the cost right, that gives us that opportunity and that advantage. So to sum up what our advantage is we've been focused on the vertical and being able to control the retail. We see that's really the brand in cannabis, and that's how our margins work, is to have that retail door, be able to supply our own product or purchase product, depending on where the cost advantage is.
Yeah, I love that, and I appreciate that. I know you wrote a great article for Todd's Substack about where you view the moat in cannabis, which right now is kind of owning the retail doors and owning that consumer pipeline, right? And from a Canadian point of view here, I think one of the largest weaknesses in our market is that we never had the opportunity to own retail. It was completely bifurcated. And a lot of those wholesale brands still haven't necessarily built a real strong, durable business. And I think that's a real testament to how important the retail strategy is, not just from an economic point of view, but also from a market share and a brand control point of view. So I really appreciate that.
Well, if I can follow up on that, Josh, I think you're spot on with that analysis. But what I really think you're indicating is that this is a commodity. And within a commodity, you're not really creating a demand. You're more of converting the demand. So when you start to convert demand, that means that it's really price is what's going to drive it. Branding has something to play with it, but not in this space and not in a commodity. It really is going to be the price that drives that and sets it. So within vertical or anything we're doing, we are extremely cautious and cognitive of what our cost is. And we don't just look at our cost of what cash we've got out. We look at what assets we have tied up and how the capital is deployed.
Appreciate that. Ohio, I know Ohio is a major focus, obviously one of the most valuable economic markets today, and I think a lot of regulation that's going to prevent kind of the rapid price compression that we've seen in some of those other markets. I know you've almost finished executing on your Ohio retail expansion strategy. I'm just interested, how do you look at kind of ROI or payback math on new doors in a market like Ohio?
Well, for us, obviously, we wanted to get to the 8, and we were able to do that. But also, from one of the things that you talked about on the first question is what's an advantage? Well, for us, an advantage also is that we don't have all of this retail going on all over the country as a large MSO would have. We're focused in a couple of areas. So when we bring on a new door, it becomes accretive to us. And I think that that's a significant thing that we look at. As far as return on investment, we're like most companies. We look at how much assets we're deploying and what the return is on them. We have not established or communicated a hurdle rate or anything that we judge that off of, but basic business principles would dictate to us on that. So we're really looking at accretive, and it moves the needle. So for us, if a store contributes 10%, that's significant to our bottom line and to our top line.
Yeah, I know a lot of us were non-cannabis for a long time, but this is a basic principle in investing in a lot of other sectors, right? Is growth off of a small base is much easier to obtain than growth off of a large base. Once you hit a $1 trillion market cap, or say you have 1,000 retail doors, adding a retail door, adding $1 million doesn't do anything for you. But with your positioning of 8 doors online, 10 in the pipe, 10, 2 more to come. Each incremental store is a much larger growth opportunity for you than another MSO. So I think that's where we're seeing a lot of focus on the smaller names, is just the relative growth on a like-for-like basis. So I think
if you're deploying capital, you're going to look at that, where you're going to get the impact and what, I think that's also the thing with Vext too, is if you're deploying capital, you also look at the structure on the balance sheet of, what that looks like. And I think we've got a pretty good balance sheet right now and have done it the correct way.
Yeah, especially ownership of assets. Yeah, it's definitely a competitive advantage there. In Q1, you noted 15% yield improvements at your Ohio cultivation facility. You also noted expectations for Q2 to further outperform Q1's improvement. So I'm just interested, what specific strategies were implemented to improve those yields, and maybe did any other benefits, such as maybe improved product quality, come in parallel with the yield increase?
Well, we obviously spend time on the genetics and the environmentals within that facility, and those have been working, and they continue to yield for us, whether we change around the environmental as far as the lighting, different types of lighting we do, different schedules and stuff like that. And it really works. Again, but it gets down to cost. So we're looking at how much can we increase the yield of the existing rooms that already are bearing a fixed cost, so that our cost per grams continue to drop. And that's really what we're after, is to improve that. As far as quality, yes, with the genetics, the THC level goes up. But again, it's a commodity which has a lot of subjectivity to it. And within cannabis, it's not like their standards. So the consumers gravitated towards the THC level, and we think that continues to rise and is to our benefit. And obviously, you're going to have the connoisseur group, which is going to be a small component of that, but we haven't seen the advantage to that from a cost standpoint, where if you try to go and chase that market, you might get a higher retail price, but your cost per grams usually go up, and it's not born in the marketplace.
Yeah, and you really need to be craft, really producing very small amounts, because it doesn't really move, and you constantly need to be turning over a new premium $60 eighth every month, because if not, it's not selling. I appreciate the take there.
Yeah, and again, it's about scale, right? So if you build a company that's trying to do 8 stores and vertical, and that, it's really tough to do that type of a market play and merchandising play, because the consumer's not willing to pay for it on a broader scale. And when you're operating eight stores, you're targeting more of a broad market.
Mm-hmm. Yeah, absolutely. On Ohio, I know you could still expand your Ohio cultivation facility if you wanted to. I think square footage could double there. So I'm just wondering, how immediate is that strategy within the context of your yield improvements? When could expanding that facility make sense?
It's going to be dictated by the market and what the demand is. So we run everything based upon demand. We don't really speculate a lot as far as what we build on cultivation. We look at what our demand is and what the demand would be on the next stores, and never really want to be dependent 100% or 50% on a wholesale market. So that's part of just our overall capital approach and operational approach. So as far as Ohio expansion, we want capacity to be able to expand, but we want to be able to expand based upon a stepped, not necessarily an all-in approach.
Yeah, I really appreciate that. I think the narrative over the last decade has been a narrative of overbuilding, and now everybody's stuck with a lot of capacity, and that's obviously going to force price compression. And I would assume that maybe nobody knows that better than Arizona market leader, where that wholesale market has absolutely destroyed itself, and you actually have this massive opportunity to begin sourcing from that oversupplied market at much lower prices than able to be supplied internally. So I'm assuming you see the same thing going forward into Ohio, maybe at just a different rate, but is it fair to assume that you see the narrative continuing?
Yeah, what I always tell people on this topic, Josh, and have for years in the cannabis space is I grew up and spent a lot of my youth in central Illinois and the agricultural parts of the country, and at one time worked at Land O'Lakes and had some exposure to that egg business. What I always noticed as a kid was whatever was full in the silos was the hot crop from like 2 years ago. And it was very difficult to time that. And the federal government has floors where they support those types of issues and those types of commodities. You don't have that in cannabis. So what happens is the states expand or somebody sees a new opportunity, they start to cultivate. And depending on where they're at, if you can do greenhouse, you try to get your costs lower than somebody else, et cetera, and work on your cost structure, assuming everybody else is going to go away and that the market's going to normalize and be rational. That takes a while and takes time. So when we did cultivation, we've always built it what I consider to be on a conservative approach of knowing that those commodities might at some point in time outrun the demand. And if that happens, then you've got a market that's compressed and falling, and your only hope for that market to balance and to be a survivor when it balances is to have your cost structure so low that you can compete in that environment. And that's what we've done. And that's why we did the strategy the way we have.
Yes, the why I call you the Charlie Munger of cannabis is because where I've seen a lot of operators over the last decade be very optimistic and building for abundance. I really do appreciate the pragmatic view of your end, obviously informed, like you said, by your past, by your history. Overbuilding, overspending, everybody was optimistic to do it. You're the one operator who's been telling us for years, no, that's not where the value lies. That's not where the opportunity is from an ROI point of view. So I appreciate it.
You participate, our philosophy has always been you participate in a market, you're not going to set it. It's very difficult to set a market. And when it's a commodity, it starts to balance itself out and everything. Despite how much people want to believe that they're going to create demand or they're going to market and create demand and stuff along those lines. Cannabis has been around for thousands of years, and there's a natural demand out there. And we recognized that and knew we weren't going to create demand. We needed to convert it and we needed to merchandise. And that's really been what we've done, is focus on how do we get somebody to want to buy from us versus somebody else. And if you're selling a commodity, you're going to have to do that on price, which means you're going to have a cost advantage and service on top of it. Quality becomes like a given and defined by that person who's buying it. They set what they consider to be the quality and where they're going to price it and where they're going to buy it. So we recognize that. Despite how much I'd love to be in a business sometime in my career where that didn't matter, I've never had that fortunate thing. I've never been Google or any of that. I've always sold a commodity product.
No, absolutely. And it goes to show that there's a lot of parallels between cannabis and some other sectors, and still very surprising that those narratives aren't necessarily drawn in parallel. which has always been a
Well, I
frustration
think
on
it's
our end.
because of the regulation. People want to convince themselves that
Yeah,
because this one's highly regulated, that it's going to behave differently and the consumer is going to behave differently and stuff like that. The only thing is some of our competitors that we're competing against are, illegal. They aren't authorized to sell it. So you're dealing with that aspect of it, more of the black market issue.
absolutely. Yeah. I know CapEx wise, you have the few remaining Ohio dispensaries to turn online. Those are already in process. So in terms of moving forward for your capital allocation strategy, what are the opportunities? How do you line up maybe M&A opportunities against doubling the capacity of your Jackson, Ohio facility, or our buyout or our buybacks and dividends an intelligent option at your current share price? I would just love to understand how you're looking at the business going forward now that a lot of that spend is concluding.
Yeah, I think, as a board, we have to talk about it, and we formally haven't talked about this as a board of, do you do share buybacks or whatever, but, obviously any business is looking at what's the best place to deploy capital. For us, I think, a combination of continuing to reduce the debt and looking at different accretive M&A transactions and potentially buybacks or, dividends or whatever. I think those are things that you all have to consider. We just need to get our stores open and see how that's going to do it and what that's looking like and how the market's behaving. And then I think as a board, we need to sit down and start talking about, where that is in the future. But for me, I've always been an operator and looked out and thought about strategically where we position and stay in within our strategy and everything. So I've always figured, let me get the spoils before I worry about where I'm going to spend them. So that's where we're at right now.
That's why I appreciate your mentality, Eric. I guess maybe a follow up to that, given that you have such a long history in that seat making these capital allocation decisions, how does capital allocation in this sector line up against the other sectors that you've been in? And from like an ROI perspective, is that the optimism there? Is that you still have a lot of capital deploy at what might be, higher than average ROI? Is that how you view the cannabis sector versus maybe your history in other sectors?
No, I think cannabis right now has a terrible ROI because I think a lot of the costs and stuff like that most people don't even think about their costs. So they talk about, what their cash cost is. You'll see that a lot in the industry standards and stuff. And so they aren't really doing a full absorption. That's really what we did as a board when we looked at what do we want to do in Arizona was, it made no sense to have capital deployed in Arizona when we could deploy it in Ohio more effectively. So therefore you shut down the grow, despite how tough of a decision that is to make from a personnel standpoint. It's just not traditional at this point in time. And those are tough decisions to make, but we made those decisions and we move forward. So I think that's still part of what is a challenge in cannabis. I think the fact that the states all operate independently is a plus, but it's also an asset question. So are you able to operate uniformly across them? Are you able to scale? Are you able to do all those things? Those are all capital decisions. I think it has to be made in the industry. From our perspective, Josh, we've always focused too on infrastructure and how it's built so that we could look at things pretty transparently and pretty real time and focused on inventory turnover and that. I always grew up in industries where if you didn't turn your inventory, man, you really paid for it. So you learn that lesson early and it never leaves you. It's kind of like once you've been smacked, you don't make that mistake ever again. So we've never really made that mistake in cannabis. And I think a lot of that has to do with just that concern about inventory management.
Well, I appreciate the take because the other side of the cannabis world is just writing off inventory every quarter and calling it a one-time thing. So
Yeah.
I do appreciate the pragmatism there and the bottom-up focus versus the top-down focus. And I think this interview is going to go a long way in getting people to understand your pragmatism and why I call you the Charlie Munger of cannabis, because there's no uninformed optimism here. It's very much rooted in reality, and we really appreciate the fact that you're never going to give me any fluff or give me any optimism in our conversations. You're always going to point out what's wrong, why people are stupid, why the model doesn't work, and why your model is the way to chase it. So yeah,
Well,
it's good to have different voices in the space.
yeah, sure. And what I tell you is, I always thought you called me that because I wasn't that attractive. So, I'm glad to hear there's a little bit more to it. But, candidly, we built everything from the standpoint of I'm very hands-on. I'm involved in the business, and I'm truly an operator. There's really nothing special or sexy about anything we do. It's just more of the discipline of the blocking and tackling. So I always used to say, I don't fit the suit. I'm more of a salesperson that's talking to you about what the data is showing and plan for my sales calls and stuff along those lines. So within this business, I can pretty much do the inventory planning at any of the facilities within a matter of minutes. So we built everything based on that and integrated it all. That was always what I did. I did a lot of re-engineering projects, and whether it was from the steel standpoint of whatever sector we were selling to, I did a lot of that stuff early in life and saw how fitting things together is a challenge. So we built the business that way. Again, you do things based upon what you know and what your experience is. So if you come into this industry and you were like a real estate developer or something along those lines, that's the way you do it. And this has a lot of manufacturing, so they had a lot of early growth and a lot of leverage because that's what they wanted to do. As you start to have a business start to mature in that, it becomes all about cost and operation. So we always used to have a term of, cost control and price discipline. And if you built the business outside of that, you paid for it, and you really weren't in that position very long. And I never really wanted to get laid off or fired when I was younger, and even today. So I approach it that way.
Yeah, absolutely. That's why we like having the grizzled vets at the helm.
Yeah. Well, and you don't. It's shareholder value that you're trying to do, and you're trying to participate in the market as best as you can. So everybody's share value collapsed and cratered as it starts to move, and that's really how I look at it. Is we have stakeholders and people that are counting on us every day to make sure that we survive as the market goes through its turbulent periods and stuff. So
yeah. All right. Well, Eric, I think we have Q2 prints coming up over the next 2 weeks. Very interested to see what you're going to be saying. Definitely interested in the context of how Arizona changes impact the business on a go forward, because I know that's the larger item. Everybody can see what Ohio's doing. So very much looking forward to the Q2 print in a couple weeks, and we'll circle up with you right after the print and get the color you can't give us today. I really appreciate the time.
That, Josh. Thank you. Thanks for having us, and look forward to talking to you in a few weeks.
Thank you so much, Eric. Take care. Have a great day.
Thanks. Bye.